All right, guys, welcome back. This is Anthony Drager for the Edge Zones portion of this Market Delta Footprint Deep Dive. And I really think you guys are going to enjoy these next two videos about this new feature that I created. What it takes is the last decade and a half plus years of experience I have, and in my opinion, creates the best visual for people to understand how to trade and create not just past, but real-time market structure. So let me just go through what I believe most people do when they start trading before the Edge Zones. Is they get to their office, might be their home office, they get in front of their workstation, they bring up some charts, they throw some lines on the chart, they write down some levels, kind of prepare, and they feel pretty comfortable, right? You think you're ready, you're prepared for the session, and now it's go time. The market opens up, starts to trade, and you're looking at the hard right edge, but you feel a little frustrated. You feel like you're missing something. And the question should appear about the present. Well, how about the present? You know, what am I missing in trading? And it's often, I like to give it a football analogy. A quarterback breaks the huddle, and the most important part of his job is after he breaks that huddle. If you're familiar with American football, he goes and reads the defense and how the defense is currently aligned to play, what they've adjusted to. Now he has to adjust. Could you imagine if you're a quarterback in football and you're not able to even see the defense, you're not able to audible, change your play, read what they're doing? You'd be missing something. And that's often what traders have. When you see a chart, it starts to fill out after the market opens, and yet you don't have any lines appearing, like this one I just threw on here. Red lines, green lines. Wouldn't it be nice if a green line appeared in here real time, showing you potential support? So when the market came down into here, it might have some support. And maybe there's some green lines that appear inside these candles to help solidify and qualify a previous support that you didn't have. You didn't know back in here when the market opened or before the market opened that there was going to be a breakout in here. Why not have something show you this visual after the market opens? Now, the Edge Zones aren't just real-time levels and support resistance. They are about the past as well, but it continues to update. So what I want to do in this first video of the Edge Zones is quickly go over kind of an agenda page wrapping up the entire Footprint Deep Dive course. First of all, the foundation should have equaled, a lot of foundational stuff should equal what the footprint rotations are all about. If you remember from a previous video, one of the previous videos in this deep dive program was about rotation for location. Being able to look at a bird in the sky as if it left a trail, what would it show you? Once you build that as a foundation, we've put together some building blocks, and now we're going to put a lot more of it together. So first of all, FP, footprint equals aggressive buyers and sellers. We spoke a lot about that in the early portion of this program. Then we talk about footprint imbalances or thin spots, which show a pickup in tempo. Then the footprint filter, where bigger buying and selling were to come in. Then some pattern strategy with the footprint, and then the tools to qualify those patterns. And now the footprint edge zone, which is going to visualize all these tools so you could truly walk up these stairs and these building blocks to put it together and go back to, all right, here's what it's telling me now. How the heck can I use it? So EZ is just the acronym for edge zones. These new imbalances are essentially auto-plotting certain thin spots. Not all of them, but certain ones. Some of the variety of things that we're going to cover, giving you the best visualization of these thin spots, are going to be how it's real-time support resistance, when they cut off and cease to stop working, not necessarily working, but moving across from left to right, predicting the next ranges, how it's going to help you tell where the next consolidations might be. Their use in multiple markets, not just the S&P E-minis, which is popular among most people that are going to trade and take this course, but how it's used in multiple markets, how it's used over multiple time frames and filters. Virgin versus non-virgin, what does that mean? Breaches, or what we call B2B moments, bullish to bearish, bearish to bullish, transitional moments. Long ones, where they came from. double stack and triple stack, what kind of value those provide. And then air pockets or gap fills will kind of give you a sense of how the market often likes to go from thin spot to thin spot, and these are going to give you a great visualization of where the next target or destination is. So let's jump right in to virgin and non-virgin. This is just a picture, obviously an image of some reds and greens that came in. For example's sake, and I don't want to get too basic in this course because we've covered a lot of that early on, but for the sake of edge zones, red ones are above the market and potential resistance, green ones are below or potential support. So you see some red ones and green ones. Like I said a moment ago, let me click on a pen here. I said that some thin spots are going to create a red line across, but not all. You could see a thin spot or an imbalance, I should say, that was in here. It didn't create a red zone across. Same thing with the greens. Here's some greens that create one. A green creates one. There must have been one from back here on the image because it created this one across. But not every green imbalance or red imbalance is going to create a zone necessarily. They're filtered with different volume. And for FootPrint Deep Dive, guys, I'm going to share some of the filters that I use in the next video to get into a little bit more detail. It's not something I'm putting out to everyone, but people who took the step to invest in their education, I'm willing to share that with. So let's get back to the title of this image, virgin or non-virgin. If a line was touched, I want people to get cognizant of, has it been working? How often has it been working? So you could help qualify and disqualify it. So for example, in here, now let's go back to talk about the rotation, right? This should have been how your eyes were visualizing this chart from several of our previous videos. Rotation, rotation, rotation. So the market runs up in here, comes off, does this, and rallies up, comes off a little bit at the end of this image. Now, virgin versus non-virgin. You could see that the edge zone was created here. It started to run across. The market comes off, goes in this green area of edge zones, comes back, holds it once, rotates back down in this green, comes back, and does not hold it the second time. Rallies in between this red and this red, and then starts to roll off. Now, this is just one image of, 6 or 7 bars. It's not going to tell a complete picture. I'm just using it for example's sake to show and have people understand if, in fact, the level worked. Now, this level here, guys, could have worked a few times previous to this image. You kind of want to know that. It might have worked, and I've said this before, it's not going to work forever. So you want to just have an idea of whether or not it's been touched, and I just use the words virgin or non-virgin to give people a sense that I want something said so it sticks in their head and they remember it. Would this rotation down in here in the green be a virgin test? No, because it already worked and tested it in here. Now, someone might say, well, Anthony, is this a better one to trade than these two? Well, it depends on some other things involved in the market, how bullish you are. Are you bullish for other reasons? So there's no scientific answer to say buy the third rotation down, buy the second. To me, the earlier on in the rotations that you're going to get long sometimes is better because you could pay for the trade and have a little bit of a head start as it went up to there, came by, went up in there. Third time ends up being the charm if you were to get long down in here in these green edge zones for the rally to take place. But what you start to understand is just for this slide, has it been touched or not? How many times did it possibly work? What I'm going to be talking about a lot. I'm not going to talk about it in this slide. I'll talk about it in other slides just for the sake of this education. You have a much better sense of whatever the zone or level might be. You guys can have some great levels yourself. You want to have a sense of how often it worked. Just remember this. The more it works, the less likely it's going to continue to work. It's like if you were running into a door to try to loosen it up. Every time you ran full steam into it, those hinges probably got a little looser, and the door is more apt to, at some point, bust open. So you're weakening the level the more attempts to it. Most people, on the novice side think the opposite, and they're dead wrong. And let them think that. They think the more an area works, the more it's going to work. So then they play it, and what happens? They get their face ripped off because it ran right over them like they were on the train tracks, and they're like, man, what the heck happened? I don't play it, I play it, and I get killed. Well, the reason is because you should have already been long once or twice in support. You waited till it over-verified. So B2B, if you're not familiar with B2B, it's a term that we use a lot in the Edge comprehensive course, and it helps people create transitional moments. And so I'm not going to get into a lot of depth with transitional moments, but when the hell does a market breach some good levels? I want people to be cognizant of that, especially with these edge zones. Anytime you have decent levels, sometimes, and there's a high probability to that, they work better when they don't work. Well, what do I mean by that? Well, I want people to not just watch when they work. I want people to watch when they don't work. So this level finally gets breached down in here, this red level, okay? They run through it. Then what do they do with these two levels? They run through it. Now these three levels here, here, and here, they might have already worked before I snapped this image. Maybe, maybe not. But all I know now is that the market's pretty bullish, but I know that when it's up in here, it's too late in a lot of respects, because you should have already been long. Whether you did or not, whether you were there was something telling you to be long down in here, don't blame yourself for that, because a lot of times down in here there was nothing to tell you to buy it. So you don't want to beat yourself up too much by saying, man, why should I have been long down in here? What could I have looked at? Sometimes there was nothing. It just worked out that there was more buyers or sellers that were going to step in and they run it up. So don't beat yourself up. However, don't do what a lot of people do, and they buy it way too late. They see a big rally. The transition has already taken place from down at this X to all the way up to this circle. And it's like, you got to be patient. Don't want to reach. Secondly, you're going to have better visuals to say there's a red zone up here anyways. There's a target, potential resistance, build a little bit more structure. But when I say B2B, it's transition. It stands for either bullish to bearish or bearish to bullish. In this case, in this image, because the market ran up like that, it's bearish to bullish at some point, right? And it starts breaching these resistance areas, these edge zones. So it's starting to give us a lot of information of, you don't have to be bullish, but at some point early on, especially when it breaches this one down in here, you better be less bearish. If you're better at identifying transitional moments, you'll be better at your timing, getting out of losers. And everybody could work on their timing. No matter how long successful you've been, everybody needs to work on their timing. In fact, the difference between successful traders and guys who never have had success is the guys who've never had success never figured out how to get consistent timing. And I really feel these levels are going to give you the confidence to strip out the randomness that otherwise existed. So let's get back to the title of this slide, breaches. What you're going to hear recurring in this video and the next is, like I said earlier in this slide, when they don't work, especially at any good level, is also important. I want everybody to think opposite of how conventional wisdom might have taught you in the past, especially in trading. So sticking to the theme of the market doing this rotation, okay? If you're bullish, when this bar starts to rally up, a couple things happened. It left a thin spot or some pick up in tempo, aggressive buying in there inside that yellow circle, and sent a double stack green edge zone, all right, live real time. It also in that area breached these two previous edge zone resistance. What you often see is a high probability of old resistance, I'll put OR, turning into new support. I didn't necessarily plan to talk about this in this particular slide, but I want to continue to repeat it because it's important and we'll get back to it. Old resistance, in this case, new support. Our next slide, the FootPrint filter. Now, from previous videos in this deep dive, everybody has understood that the filter is both when big buying and selling could move the market like it should, or when it can't and it should. The clue is when the guy touches his hat every time he puts in a big bet. He might be bluffing. The tell that you pick up and the skill that you create when you're a good poker player. You could read all the books in the world of how to play good poker, but implementing is where the skill is. That's after the bell rings, right? That's after the game starts. That's why everybody's pre-market homework and preparation is great, but if you ain't good and even better after the game starts, you can do all the homework in the world, ain't going to do you any good. So going back to the filter, what this is, what the edge zones now do is give you a better visual of when these instances come about, when they work, when they don't work. For example, right in here, we see the market have a 223 lot buyer. Does it work as subsequent support? Yeah, but we know that afterwards, right? In real time, you could assume that's going to happen. It's easier to say it works afterwards and everything else. Another 200 lot buyer comes in, 200 lot seller comes in, can't get it to go down, has a little bit of a 4 or 5 tick pop, and then it runs back down and does what? It gets through that red. If I were to draw a visible line across, and it should stop here. Now, there could be reasons why it didn't. Could be some fundamental news that came out. Who knows? Something that was real bearish. It should have stopped and had a decent probability of using that as support. Why? Because good buying came in and did what it should do, sent it up. Generally, that turns into good support. But I took this image on purpose. I didn't want it to work. Why? Big seller came in and got the market to continue down. Not only breaching this level, but breaching this level. Going back to what I said in the previous slide, this time, old support equals what? Potentially new resistance, NR. That should be an R. Not only did they breach areas of potential support, but they threw in new resistance. Remember, this is on a filter. Go back and watch, if you're a little fuzzy on the filter, the video I did earlier on the deep dive about the FootPrint filter and why these numbers would appear and how you could change your settings for what you deem to be big size. This is a image of a chart of the S&P minis. So the filter is going to be different with the different markets you trade. If you trade the NASDAQ, the NQ, your filter isn't going to be 200. You'll never see anything. Crude oil, you'll never see anything. The Dow, YM, you'll never see anything. But even if you trade individual stocks, there's a certain amount of block shares that you're going to put in that's going to create a nice filter. Like I mentioned in the FootPrint filter video in this deep dive, the sweet spot is when you don't get too many or too few. So if I had too many of these reds and green lines that was showing me big buyers and sellers, then it's not a good filter, is it? Too much is getting through. If I don't have any, well, what good is it doing me? It doesn't show me anything. Always go through the rotation of a chart. So are you bearish or bullish when you see that? You should be bearish. Even before you see it continue to move lower. Should you look to use this as support? Yeah, especially that 2 others didn't work. They're going to use this one most likely as a target and support. I'll talk later when we go to live charts, probably in the next video, about when you have a nice confluence of big buying and selling in the filter at the same time you see it in the unfiltered chart, when you get an edge zone on the filter and the unfiltered. So let me erase some of these illustrations and come back and say, all right, you're bearish before it has to run all the way down in here. By the way, the novice is bearish way too late. They're bullish way too late. They're reaching. That's why your transitional moments and using these edge zones, not only for near-term support resistance, but also B2B moments, transitional moments when the bulls take over, in this case, when the bears take over. It also gives you structure as to where it might come back and retest for you to do what? Get on the team. What team is that? On the short side of things. If you try to get on the team down here, you're going to have to take some heat. But if you find good structure that can offer you good areas of not just where to get short, but where the hell to get out if and when you're wrong. That's a very important part of this. There's a slide I think I talk more about. Another value of these edge zones is not just where to get in, but where the heck are you wrong? Let's say, for instance, you were long or already long from back in here, or you got long here and you got picked off. You could get out here as your sell stop instead of having to ride it down in here. Knowing where you're wrong sooner rather than later is going to have you have smaller losers. You're going to get picked off, and you're going to buy it, and you're going to get stopped out at times. That's trading. There is no business that doesn't have outlays. Trading losers are like outlays to your career. If you're listening to this program, many of you have been in other businesses, ran your own businesses. Did you not have to pay for marketing, for advertising, for maybe employees? Or if you were just an employee of a company, didn't you have to pay for gas to get to and from work? You had expenses, didn't you? Whether you were the employer or employee. Well, as a trader, you've got expenses. They're not just your platform fee or education or maybe trading rooms, things like that. They're also trading losses. You want to minimize them, but you're not going to eliminate them. You're going to want to have them because it means you're being consistent. Now, going into the value of not just a footprint filter, but good levels is, when the hell should I be wrong? Where the hell should I get out? I get asked that question over my course of helping others through education. Where to get out? Where should I put my stop? Where should I put my stop? And it's a great question, and it's an important question, an important part of your technique. And when your mechanics are good and you're trading well, it's because your exits are better than even your entries. You're not getting shook out and then it goes. Your locations are better for both getting in and getting out. So these levels are going to help you say, I know where I'm wrong at. And it's going to get you more comfortable getting in. Hopefully that makes sense to you guys. All right, multiple time frames and multiple markets. First, multiple time frames. We're going to go over a lot more charts, in another video. For just your first look at multiple time frames, let me use a 12 PNF. Now, I'm not a PNF stands for point and figure, and I'm not a point and figure expert. I could have done a point and figure video as part of this course, but it's pretty simple. If this was a 4 PNF chart, it's a smaller time frame. If this was a 60 PNF chart, it's a much higher time frame. It's not minutes, but the concept is the same, right? A 2-minute chart is a smaller time frame than a 60-minute. Same concept with a PNF. With a 12 PNF, and I'll walk you through this because it's important whether you know it or not, it's always got up bars and down bars. Should be coincidental. That's the way I want people to follow a market anyways, correct? PNF is up and down bars. So for example, if this one is an up bar, which it is, it's not going to create its next bar, which is down here, which is this bar, until it retraces 12 ticks below whatever the high ends up being. So it's constantly measuring what's the high, what's the high, what's the high, what's the high. And until it comes off 12 ticks, it's not going to print this next bar. And when it does, it'll print it, and this will be the down bar. Guess what it does? It's always measuring the low of the move. And whenever it rallies 12 ticks above the low of the move, this bar will form. And it measures the high. 12 ticks below it, this bar. And so on throughout. That's how you get the rotation. That's why minute charts don't always show you rotation. Range charts don't always show you great rotation. And if I had this as a 60 PNF, that's not going to show you great rotation because there's going to be a lot of things that happen in one bar. But I do want people to just pretend you're on the ground when you're on a 4 PNF chart. You're in a drone maybe, or a helicopter when you're on a 12. And maybe you're in the plane when you look at it daily. That's kind of the metaphor or analogy I want you to see. So you could throw these up with different volume filters that don't give you too many or too little edge zones. So when I say multi-time frame, this image is again of the 12 PNF. You threw in, on the beginning of this move, a green zone that led to support. The other thing that I didn't mention is that, and I should, is that these zones are one price wide. You know, a lot of people have zones that are 4 ticks, 8 ticks, 3 points wide. There's a lot of room for error. Now, you could have a 1 or 2 point wide zone in the NASDAQ because that thing whips around. But all these edge zones are just showing you one price. So there's only a 5 tick difference between this zone here and this zone in there. And you could start to use the ones that are tight as a zone in and of themselves because these are one price wide. But let's erase this for a second, that illustration. You could see selling and balance selling start to come in there. And it calls the top of the move. Real big move lower. Comes down. Throws in an edge zone in there that goes across. Starts to rally up. Throws one in there that starts to go across. It gets through this red one. But here's what's really important about understanding 12 PNF or 60-minute edge zones. Is you see how it got through it and it looks like it just effortlessly went through it. If you look at a 4 PNF, I can almost guarantee you that it rotated a few times before it blasted through. So that's the one thing you want to make sure when you're looking at higher time frames or higher number PNFs, that it looks like it didn't hold, but if you look at a 4 PNF, it did. We'll get into that when we go over some higher time frames on different charts. So I could show you stuff by just going back and forth without just having it be an image. So remember that. It gets through there, right? That should help you be bullish quicker than having to wait all the way up here. Listen, most people, after it rallies, whatever this is, maybe 8 points, they're bullish up here. Wow, great. A little late. When could you put your horns on earlier? And again, this is a big helper for that. Where does it go up and stop? At an edge zone. Where does it come back and stop? Edge zone. Where does it get through? Probably worked a couple times before it went through. Stops right in between those two, right in between those two, right in between those two. Rallies up. Comes down. Where does it stop? And put in another right in there. Rallies, stops, finally breaks through this edge zone on a 12 PNF. But we'll go over and I'll show you an instance where it gets through a 12 PNF. Then we'll look at a 4 and you could see it working for a while before it doesn't. Let me get rid of some of these so they're not too confusing. But on a 12, when you finally get through what was some pretty good support on a 12, what are you? You're probably bearish quicker. And you should be. So don't kid yourself. These aren't just zones like any others. It's the implementation of them. It's how to create better transitional moments, because the structure and the visuals are always updating. This, and I wish I knew the time of this image, but I could tell you that area is going to be great. What? Resistance. Why? Old support, this green line, new resistance. Right in this yellow rectangle. And the market comes down and holds these two. Longer time frame. But you'll find it interesting when you see a 12 on a 12 P&F chart, it just gets ripped through. But you look at a 4 and it like banged off it a couple times before you would have got your face ripped off. So you had more time and maybe even made money on a 4 P&F trying to play this area to the long side. But on a 12, it looks like it just ran right through you. Really important to know, and what people struggle with when they just use too high time frames for all their trading. It looks a lot different than when you're on the ground and you start to be like that image I showed you at the beginning of this video, the guy pulling his hair out of his head. Because what you prepared for on charts that already filled out always looks different when the damn game starts. So this is a multiple time frame. We'll go over dailies on another when we go to live charts in the next video, but just to give you a sense that yes, you could use these on multiple time frames, minute charts, or, anything, and then you set your filter a little bit different. I'll also cover that, but you want to set your filters a little bit different with different time frames. Always go back to this though, the sweet spot. Don't overthink it. Too many reds and greens, it's too noisy. Too few, what do you, no tell, no information. You want that sweet spot. Like I mentioned, also multiple markets to use them in. In this case, I talk a lot about the NASDAQ and the crude oil because they influence the E-minis a lot. But this is a chart, I believe, of the NASDAQ. And I wanted to show another example of what? Old support that did work. Let's do the rotations again like we do. We try to do with every chart. Okay, that's how your eyes should have been fixated on this particular image. You could see support working a couple times in this NQ. The third or fourth time, because I don't know what it might have done before this image was cut off. But the third or fourth time, what does it do? Blast through it. You should be pretty bearish. Not right underneath it, but at some point underneath it, you should say the bears are in control. And this is another good old support, new resistance right in here. And we're going to create in as we develop these edge zones or add to them different filters to show the this line transferring into more information. I don't want to get into that for the sake of just sticking to the topic. But some real cool enhancements to make the visuals even better. I always say this to people that if you ever followed me for any period of time, my concepts don't change, my techniques don't change. I just help people find better ways to look at the same thing. Better ways to look at the same thing. Better ways to review. Doing something to help people review better, because that's a very important part of trading, but very cumbersome and tough to do, but yet super important. How do I help people do that? How do I help people stay engaged? The trading room. You don't have to be distracted. I often tell people, if you allow other people to distract you from what you're doing, you got to get better at not being distracted. You don't eliminate all that stuff. I mean, it's easy to say, hey, I'll be real happy with my wife if I just never have to see her again. I mean, well, no kidding. But if you're going to coexist, you're going to have to work at it. So in trading, you want to be good at not being distracted without having to eliminate the talk. People that come to my room, most of them love it. The ones that might not stick around, well, I don't like to get distracted. No. you need to listen. As long as the guy you're listening to knows what he's talking about. Obviously, you don't want to listen to a knucklehead, but if the guy knows what he's talking about, you want to be able to listen to someone like you listen to music. Sometimes you're singing the song and you're real into it. Other times it's just background music. You know it's on, but you're not having to follow it. It's real important. So multiple markets, whether it's the NASDAQ or crude oil and other markets that will show and stocks that will show, you could see them working. Again, the filter is going to need to be adjusted because the size and volume that happens in different markets is different. If you use the same filters in the ES as you do the NASDAQ, you won't see anything. Or I should say, if you use the same filters in the NASDAQ as you do the ES, you won't see anything. This is, I believe, crude oil. All right, crude oil gets real bearish in here, throws in an edge zone of a place of potential real-time resistance, comes off, comes in, comes off. Is this a virgin area in here? No. It was in here. It was in here. It's not in here. Finally bangs through it. What does it create? Old resistance, new support. How many people talk about their levels when they don't work? They're even better. Think about it. If you've ever been through any other education. So many people out there are so, their feedback I get from traders that go through my stuff, talk about other things they've learned. My take on other people who try to educate and teach this stuff is they're pretty insecure. They want to talk about winners. They want to talk about being right. And I'm the opposite. I want to talk about being wrong because that's what you got to be good at. So I talk about the levels working a lot, but I also want to bring people's attention to when they don't work. That's really important. So I believe this is the crude oil right in here, and you could see it come across and be decent support as the market rotated back down. But let's do this again because you got to make sure your eyes fixate on the market like this. I could automatically tell you if it's an up or down bar. Obviously, it's every other bar, but every time I draw these illustrations, I'm not doing this, right? I'm not going in, oh, this is an up bar, and it came down here, and then it came there. Wait, what happened? You got to get good at, wow, this was a down bar. Why was it probably a down bar? Without even seeing any of these other footprints. Well, probably a down bar because it's got all this selling in there. That's why. So the direction was probably down. More selling, more imbalanced selling. Hopefully that helps make sense. And your visuals are better and better. This actually might be the crude oil. So I apologize. The previous one was the NASDAQ, but same concept. Here's the crude oil that's throwing in a lot of resistance and a lot of support. And what we have here is a lot of red clouds up here, a lot of resistance. You see them work really well. Going back through the up-down nature of the market, right? So if the market came down in here, rallied, came down, rallied, that's the rotation. And you could see it when it finally gets, let me clear this up. When it finally gets through a lot of this support, comes back up and uses it as resistance a couple times. You've got all this red. You can say, well, Anthony, it flew through here. It should be old support in here. No, these are 1 penny wide zones. You got to do better than just getting through a few ticks. And you got another one up here. These are 1 penny ticks. You could see if you sold oil in here off of this zone, look at the head start that you get before you get tested. And then you're not even tested through where you probably ultimately be wrong on a short, which is above this red initially. And then you adjust accordingly. But you can't make this stuff up. You got support that was put in here, and it works. They start to move through, but then it comes back in, throws in some more green. Is this area going to be supported till it's not? Yes. Was it? Yes. Very important to understand. Also, think about this. I think I mentioned this a few slides ago. When you do your homework, what happens? Did you have any good support resistance 3 hours after you did your homework? Were you privy to some of these levels? Well, no, because the game didn't start. You don't know what might have happened after the session started, before the session starts, where the tempo could have picked up. Don't try to predict too much of the day, especially before the day starts. That's crazy. And that's where people get stuck and trapped doing when they try to prepare for their session and think they're ready to go. And they get frustrated because they're not allowing themselves to acclimate to the market after the bell rings, after the session actually starts. You know, you didn't know that there could be some really good resistance up here before the session, but as the session goes, they threw in some real-time resistance in that case. There's a lot of ways to build on these edge zones, including confluence between ancillary markets. Let me talk about that for a second. Without an image, take your notebook out and write this down. If you're trading the S&P E-minis, right, wouldn't it make sense to look at the NASDAQ and sometimes crude oil? Do you know crude oil could move the stocks around? You should, because they often do if they have a big move. Why? Because the CL market, crude oil, is going to affect the energy sector. XLE is the ETF for the energy sector. Did you know the energy sector is like the second highest weighted sector in the S&P index? So it's going to affect the ES. Again, big moves. That's why often crude oil could affect your S&P. It should be obvious why the NASDAQ is going to affect the S&P. They're both stock indexes. You could build on that a lot. In the Comprehensive Edge course, we do that weekly. And that's what's unique about the Edge course, is that there's constant circling back that we do to keep people engaged. We have weekly meetings every Tuesday to go over stuff. Not just newer stuff, but go over concepts, building on it. You get to meet the other people that join the whole Edge course and collaborate with them. See what's working for them. Go over these confluence techniques. You know, what market's influencing what market better. Here's another interesting concept. The 30-year bonds, sometimes when they go down, especially down hard, the S&Ps go up hard. Well, you want to know that if the bonds make a big move, and you don't ever have to trade a bond in your life. But it would make sense to know the bonds just are having a big move lower, because it might get you into a long trade if you're bullish. Might get you the hell out of a short trade if you're bearish and short, before you have to get stopped out. Ancillaries are important. If you don't think they're important, then don't ever compare airlines when you buy a ticket ever again. You're a hypocrite. If you don't think ancillaries in trading, one market looking at another one, matters, if you don't think that, well, then why would you go and compare and contrast airline tickets trying to find the cheapest one? Because that's what you're doing to find value when you buy that. Tell the bank that they're crazy when you go for financing for doing an appraisal on the house. That's the technique they use to find value, to see whether or not they're going to finance a deal. When you buy a car, don't look at any other car lots. Just trust the salesman's giving you the best price. But that's the building blocks that this deep dive does through these video through video package that we provided. That's what the Comprehensive Edge course does, and so on. So multiple markets, yes, they work for multiple markets, multiple time frames. Now, Something that I think is pretty cool is air pockets. The last two slides I think are pretty interesting. And we're still doing another video on edge zones as part of your footprint deep dive. Air pockets or gap fills. A lot of people like a gap to be filled. What does that do? It provides a lot of interesting targets, right? So if you think that once you get through this edge zone, you're going to go to a collection of edge zones that are below. A few things happen here. Number one, you're going to get bearish for the right reasons, for high probability reasons. Once you get so many ticks below this edge zone, you have a magnet which gets you bearish. Now, there's a lot less randomness in that opinion, isn't there? What I just said. Once you breach a nice area of support and you have a magnet below, the downside would seem to be the right side. Your probabilities go up and you just stripped out randomness. Then you also tie in old support, new resistance. Market comes up, stops, sells off. Here's where it came. If you look at those reds in here, look at that. Market comes up in here, stops, rotates back down. This wasn't an official red edge zone, but it's a thin spot. And I took this example because back in the day, before the introduction of these edge zones in the footprint, I would tell people thin spots, and I would tell people this is going to be good resistance. And there still wasn't a high enough grasp of this being resistance unless there's a physical line drawn in there. I go over the concepts with the baby bird story that I've told. I don't know if I've told it in this program, but I go over that story as to why resistance is resistance and support is support. The fact that you actually see a line will give you more comfort, but you got to understand why that line is there. And you want that line to be what? You want that line to be because of the dynamic of trap traders, because of the dynamic of the tempo picking up. That's the other thing, is that don't ever worry about too many people finding out about this. Because first of all, they won't. Most people don't want to go down the simplistic route. They want to overcomplicate everything and then have everybody else do the work. Okay? That's number one. But number two, let's just say the whole world was using edge zones, okay? They only work and become high probability levels because they're showing you where the tempo picks up and where there's trap traders. So what's going to happen if everybody knew about them? Would there never be tempo that picked up in a market? Would there never be trap traders? Of course there would be. So don't worry about that. This is so much of a bigger world than you, than me, than us. It reminds me of my proprietary firm days. I was the 20th guy hired. As they hired more and more guys, I thought more and more competition will make less money. It was the opposite. Hired over 100 guys. I made more money when there was 50 guys there or 100 guys there than I did when there was 25 guys there. It's a big world. But it is an edge, that's why it's called an edge zone, over your competition. Because not only are they not going to get it, most of them aren't going to see it because this stuff is in the back of the store, but they're not going to invest in a course like you guys did to understand it and to have the ability to play back this education. And hopefully you guys understood how we built it out in a very intentional course and just a bunch of topics we threw into videos. I think you guys understand that. So the air pocket would be, once it gets through here, there's a pocket of not a lot of support until you get down to there. And it's going to fill that gap. And I want people, when you have access to these things, come to the trading room for at least a month or two and watch them and see it, whether or not you put it on your platform or get the Market Delta desktop to use it. or not, but at least put yourself in a position to see these different ideas working in multiple markets as well. Now let's go to my favorite slide of this video. You see pictures of a house. Now stay with me on this one. Hopefully this helps wrap up everything and creates a metaphor that'll help you understand the dynamic of why these are important and why they create high probability areas, okay? So, first off, EZs are what? Edge zones, the acronym for it, with the delta profile. And you don't see the delta profile up there. We're going to talk more about this in the next video. We're going to tell you what the delta profile is, even though it was another video in this program. I think early on Trevor did it. The delta profile and how that calculates what it shows you, and how it's a little different, but the same theory behind delta profile and these edge zones. But we're going to tie them together. But before we do that, I want to leave you with this particular illustration. Let's say you got houses that sell for $250,000, and in that particular area or neighborhood, a lot of them sold at one moment in time. There was a lot of inventory that came out at $250,000. Then the market got hot, which means what? Price rallied. It rallied from $250,000 quickly up to $300,000, where the next collection of a lot of inventory came out. So two things happened. A lot of people in there didn't buy houses, or not too many people bought houses, and this is thin spots in the footprint, in the edge zones. And this collection of houses start to show where a lot of people bought that house and could, in fact, be open longs. Just stay with me for a second. Open longs down in here, quickly scooted through the 260 area, all right? A lot of houses then got sold at 300. The people down here, what do you think when they go to sell their house and they seen it rally to $50,000, this is important to them. This is almost like a magnet for a price. They know where they bought it. They don't want to sell it any less than where they bought it. They're willing to come down. So a couple things happen. First of all, I inserted the delta profile to show you a lot of open longs down in here and maybe up here. That's what the delta profile shows you. Much different than a market or a volume profile. I believe, Trevor covered some of this delta profile in the video 2 or 3 of this program, but we're going to talk about it more in the next. So 250 to 300 are the magic numbers. But what happens when you see this and you see potentially an edge zone, which is a thin spot, be a little confluence with open longs or a delta profile that sticks out? What do you think happened when the market rallied from 250 to 300? Do you think you left some people behind that were mad they didn't buy it? They tried and they couldn't get it? You're damn well right they were. And who do you think was the most angry? Their wives. Dummy, why didn't you just buy it at 260? I told you not to be greedy, or I told you not to be cheap. Just get it. So now, if the housing prices come back down near the price, the bottom of the thin spot, and where a lot of people bought this house, $250,000, what do you think happens? This guy says, I ain't missing it this time. I ain't listening to the wrath of my wife this time. And he jumps and buys the house, pushes it up a little bit. Next guy says, I ain't going to miss it. Another guy says, I ain't going to miss it. And they push the houses back to the other open delta profile. That is an analogy or story to help understand if houses moved a lot faster. The same concepts or techniques apply to the price of homes. It just moves a lot slower. If we sped it up, there's a reason why this would be a magnet, if indeed there was open longs there. So in a market, And on a chart, on a dome, if you could deem where there's open long positions, shorter term, but open long positions, it becomes a magnet, because what do people who are long have to do? Buy or sell to get the hell out. If you're long, you have to do what to get out of that position? Sell it. So if there's a lot of them down in here and they're all trying to sell, they're going to sell it right back down to where they got in, and there's probably going to be people who missed it on the way up. That'll be the support that chase it back up. So if you could find where there's open longs, it's generally a magnet for price to return, given the fact it might be higher, if in fact it's higher. So if there indeed is a lot of open long positions here and price is above it and some selling starts to come in, generally, it's going to drive it right back down to that magnet. So edge zones with the delta profile. If there was an edge zone, it would come in right around here. And it would be really close to the delta profile. And I'm not trying to give people the sense that every time you see a green delta profile and a green edge zone, you'll make $1 million. It works every time. I'm giving you the concepts and the techniques to do what? Tie it together and strip out randomness. If you could strip out this word, is the only time that you could get and stay consistent in trading. And if you think about it, are you going to be able to build a deck as a carpenter if it was always random to you? Of course not. You can be an electrician if it's random to you. Are you going to be skilled to do anything if it's random to you? No. It's when it stops becoming random, do you then start to understand it. In other lines on a chart, stochastics and moving averages and relative strength and Fibonacci and TPOs and HLV, HVNs, all those, that's not giving you the understanding you need. This stuff is. And it's also a visual. We'll see you guys at the next video.